Well, good morning, Jaginder Rana here. The topic for our discussion today is reversionary interest and life insurance. Reversionary interest and life insurance. If the assured under a life insurance policy does not receive the benefit of the policy until it matures, this is termed a revolutionary interest. Because of this, life policies are freely assignable. Further, insurable interest is required only at the time of commencement of insurance. So an assignee in life insurance policy would have right to sue in his or her own name on the life policy, provided a notice of assignment has been served on the insurer and an acknowledgement of such notice has been received. So life policies may be assigned to anyone whether or not they have an insurable interest in the life assured. The assignee acquires all the rights and liabilities of the original assured. So for the life insured to regain his rights, the policy has to be reassigned to him. An assignment of a life policy could be conditional to the happening of a certain event. For example, a life policy could be assigned to the spouse in the event of the death of the policy owner. So the policyholder remains the absolute owner of the property so long as he is alive. An assignment of an insurance policy normally means an assignment of the rights under an insurance policy. However, there is another less complex form of assignment, and this occurs where the process of a policy are assigned. There is generally no objection to assignment of the policy proceeds. So in this way, as the insured is still in contractual relationship with the insurers, he must therefore continue to comply with all conditions in terms of the policy. So the only difference is that the insurer is directed to make any claim of money payable to some person other than the insured. Insurers can protect themselves when making such a payment by asking the person receiving the money to sign a form discharging the insurer from further liability. So the most common situation is that found in motor insurance. The payment for crash repairs is nearly always made direct to the garage, who obtain a satisfaction note from the vehicle owner. As far as nomination and assignments are concerned, both are different things. It's advisable for a life insurance policyholder to appoint a nominee to receive the policy proceeds becoming payable in the event of his or her dying during the term of the policy. So the nominee, unlike in an assignment, does not drive a right to sue the insurer except after the policy proceeds have become payable to the nominee. Further, the policyholder may change the nominee without consulting the previous nominee or the insurance company. The nominee has the right to receive the claim amount from the insurer in the sense that he can give a discharge to the insurer. However, the nominee is liable to the legal heirs of the deceased policyholder. So once the payment is made to the nominee, the insurer has no obligation to legal heirs. In the absence of a nomination, the dependents of the deceased policyholder will have to submit probate and other relevant papers as proof of right to a claim. Because marine policies are making the payment of money under two different circumstances. One is maturity and the other is death of the assured during the policy period. So under both the circumstances, it is necessary, and the first question is to whom the money should be paid. If the maturity amount is there, it is undisputable because the direct payment of the money will be made to the insured himself because he is surviving. But in case of death of the assured, this dispute always arises because as long as the name of a nominee is there, it becomes very simple for the insurance company to pay the amount of proceeds to the nominee. But in case of no nomination, insurance company has got no authority to pay any person selected by them. If the claimants are coming with the different legal certificates or different probates, actually the court has the insurance company has to decide to whom the claim has to be paid. Because kith and kins or the claimants could be anyone of the family members. So succession certificate or the legal certificate is the only document which gives the reason for payment of the claim. Typical payment type policies are whole life policies and endowment policies. These policies are regarded as saving instruments. So both are in fashion. Whole life assurance, endowment assurance, assurance for children, term assurance, increasing term assurance, decreasing term assurance, family income policies, convertible term assurance, even life annuities, or then joint life assurance and annuities. But nowadays the most common one is industrial life assurance. Because the function of industrial life insurance, as distinct from that of ordinary life insurance, is to bring life assurance to those who, by reason of circumstances, would not normally be interested in carrying assurance cover. They are of the lower income class, and it has been recognized that once a life policy has been effected, the best way of maintaining it in force is to collect premium from homes of the policyholders, as there are many demands on the income of the family. It is often difficult to save or yearly, half-yearly or quarterly payments. These are therefore made at more frequent intervals, say every week, fortnight or month, under the industrial assurance contract than under ordinary life assurance contracts. Each premium payment is similar, smaller, and a call on the policyholder is made for it. So in the UK, there are many more industrial life assurance policies in force than ordinary life policies. But they are for smaller amounts. Endowment and whole life assurance are the most popular form of contracts in the industrial sector, normally with low sums assured. It is also common to see recurring endowment which provides whole life cover and the payment of a small amount at regular intervals, say every 5 years. There are insured pension schemes. So pensions to the retired employees are also there. These are the pension schemes provides retirement annuities called pensions and other benefits which are usually related to the length of their service and salary. Many pension schemes are insured by means of group or master policies issued to the employer or to the trustee of the scheme. So in addition, the employer may choose to take group life insurance. Thank you very much.